This conference will now be recorded.
Hello, let's start with the insurance basics and terminology that you need to know for your exam. Insurance. Definition of insurance is to indemnify another because they suffered a loss from an uncertain or unknown event. That's kind of condensing it. I mean, I guess the rigid definition would be it's a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. So insurance is a contract to indemnify. Now, whereas contracts can be in writing or not in writing, insurance contracts are always in writing. It's to indemnify you, which means to restore you to what you had before a loss, to make you whole again. So if you had a 3-bedroom, 2-bath house and it burns up in the fire, having the proper insurance in place, the insurance company will cover the cost to rebuild the exact same 3-bedroom, 2-bath house. Now, the loss must be uncertain. So with this fire in your house, the loss must be uncertain, which means if a brush fire is already heading to your house, you can't buy insurance because that's a certain loss. Right? So for insurance, it's a contract to indemnify you because you suffered a loss from an uncertain event. That's how you want to know it. Sometimes the test will give you a one-word definition. Definition of insurance is which of the following, and look for contract. All right? Again, it's a written contract if you see that. Now, that's the definition of insurance. The concept of insurance is to transfer risk. It's a transferring risk from those few people that suffer losses to everyone buying insurance. Right? And so we have insurance companies measuring the past to predict the future, and they're predicting expected losses in the future. That's what that is. So risk transferring risk from a small group, those people that suffer losses, to a large group, everyone buying insurance. So in auto insurance, you're required to have it, typically in most states, and you're required to have a minimum amount of liability. And so, but not everyone has a loss. But everyone basically is paying premium for it, and the insurance companies collect this money and they pull it. So if you suffer loss, with everyone paying premium, they have enough money to cover those losses. So indemnity means to restore you to what you had before a loss, to make you whole again. And again, if you had a 3-bedroom, 2-bath house and it burns up in the fire, to indemnify you, the insurance company will cover the cost to rebuild the exact same 3-bedroom, 2-bath house you had before the fire. Right? We're not going to give you a gain, build you a 5-bedroom, 3.5-bath house with a sun deck, a pool, and a jacuzzi that you didn't have before the fire, because that improved your condition. That's not what insurance is about. Now, for life insurance, it's a little different. Because if an individual dies, we can't replace them. We can't rebuild them, right? But we can replace the income that they would have normally brought into this relationship if they were still alive and working and contributing financially. And so it's still indemnifying, the surviving family members, but it's not the same as rebuilding a house. You can't rebuild a person. Right? Now, in order to buy insurance, you have to have insurable interest. The technical definition is having a legitimate economic or financial interest in the preservation of the life or the property that is the subject of the insurance. More simply put, in order to buy a policy on someone or something, you have to be financially effective. You need to have a financial interest. A lot of times the test will use economic interest. Okay? That means whatever you're insuring, if it suffers a loss, financially there's an effect for you. So for life and health, you only have to prove insurable interest one time at the date of application. Right? Now, you may see date of application. You might see when the policy goes in effect, right? The time of application. I mean, there's a couple of different ways of saying that. But when the insurance goes into effect, you have to prove insurable interest. In the property and casualty world, you actually have to prove insurable interest twice. When the insurance goes into effect and at the time of the loss in order to collect. So keep that in mind. Life and health insurance, you only need to prove insurable interest one time, but in the property and casualty field, you got to prove it twice in order to collect. Okay? The definition of the word person. Well, person, according to the insurance code, is person, association, organization, partnership, business, trust, corporation, limited liability company. So it's basically any legal entity. Okay, a natural person is a natural person. A natural person is an individual human being. So a natural person is a person, but a person is not necessarily a natural person, because a person could be a corporation. So on the exam, when you see solicitor, an insurance solicitor, they're typically a natural person representing a property and casualty broker agent and transacting property and casualty coverage. So understand that. An agent or broker is a person. A life agent is also a person. Now, a person means it could be a corporation. And so a partnership could set up an insurance brokerage. Okay? A business trust can set up or be an insurance agent. LLC can be a life insurance agent, right? So person is any legal entity. A natural person is an individual human being. All right, some other things to know. Law of large numbers. Always remember that insurance companies measure the past because it gives them predictability as far as the future. All right, now in the life and health world, we use mortality and morbidity tables. Mortality tables predict what's the likelihood of an individual dying, right, based on their age and sex. And they're broken down into 1,000, right? And so out of 1,000, using a 2001 Commissioner's Standard Ordinary Mortality Table, out of 1,000 male babies that are born, one is expected to die at birth. Now, we don't know which one. We can assume that it's going to be one. We can expect one because historically that's what's happened. You see what I mean? And those are mortality tables. What's the likelihood of you dying? Morbidity tables are for health insurance, and that's what's the likelihood of you becoming sick, injured, or disabled. Right? So, and insurance companies track this because this is kind of the premium basis, actually the basis for their premium. This is the first factor in determining premium. Using a mortality table, what's the likelihood of an individual dying? We can kind of convert that into a dollar and cents figure, right? And so that's basically how we start off with the premium. In property and casualty, it's called the pure rate. Kind of the same thing. It's a starting point. You know, if there's a 35-year-old female that's driving a 2019 Honda Civic in this location, every insurance company starts off with the exact same rate for that 35-year-old female driving that 2019 Honda Civic in that area, okay? But then the risk changes or the price changes because of interest and expenses. Every company has different numbers there. Maybe going over your head a little bit, we'll come back to that later, okay? Risk. Risk is uncertainty of loss, and that's a key word. Risk, uncertainty, okay? They kind of go hand in hand. It's uncertain that you may suffer loss. Your house may burn down, it may not. You may get into an auto accident, you may not. You will die. The uncertain part of that is we don't know when. All right? Because if we knew when, well, that's a certain risk or certain loss, and insurance companies will not insure it if it's certain. Okay? In selling life insurance, I never had an office because who would be knocking on my door wanting to buy life insurance? Typically, that person who just came out of the hospital, found that they got diagnosed and they have 6 months left to live. We can't insure them. That's a certain loss. Right? So risk is based on uncertainty. Now, there's two types of risk, speculative risk and pure risk. When you hear speculative risk, think of gambling. There's a possibility of loss or gain, possibility of breaking even. And we don't insure that. If you can get a gain out of insurance, the insurance company will not issue the policy. And if they did, they limit what you can collect. Right? So there's no gains in insurance. So insurance, we cover pure risk situations. Pure risk means possibility of loss only, no gain. Right? So you cannot insure the outcome of a sporting event because you can get a gain. You cannot insure the outcome of the lottery because you could get a gain. However, you can insure the liability at a sporting event because someone could suffer a loss. Right? So that would be the pure risk situation, and that would be the insurable item. Right? All right, so once we determine there's a risk situation, how do you want to manage it? All right, so we have 5 methods. STAR, S-T-A-R-R. That's probably the easiest way to remember it. Although sharing is kind of a subcategory of transferring, I would say. And we'll get to that. But let's start with retention. Retention is don't buy insurance. All right, so I live in California, and the majority of the homeowners in California didn't buy earthquake insurance. They feel it's not going to happen to them. So if an earthquake rumbles through and totally destroys everything they own, they're going to have to cover the cost out of their back pocket because they didn't buy insurance. So ultimate retention risk is don't buy insurance. The only time you would really retain risk, right, is number one, the worst case scenario is known. Number two, you could afford it. Okay, so that's how you want to understand retention risk. The only time you'd really want to retain it is, like I said, if you knew the worst case scenario, how much it would be, and you could afford whatever that was. That would be retention of risk. Okay, so another subtle way of retention of risk is raising your deductible. So for your personal auto policy, instead of having a $250 collision deductible, or if you hit someone and you damage your car, you pay $250 before the insurance company would start fixing your car. Raise your deductible to like $1,000. So now if you hit someone and damage your car, you'd have to pay $1,000 first before the insurance would kick in and cover the rest to repair your car. Okay, so you're retaining more of the claim at the time of a loss before the insurance kicks in. But by raising your deductible, you're actually going to save money in premium. And that money you save in premium, you can get some other coverages or do whatever you want with it. Okay, so that's retention of risk. You have the ultimate going without insurance, or more subtle ways, raising your deductible. Reduction of risk. Well, so those people that didn't buy earthquake, one of the things they could do to reduce the risk of damage and loss from earthquake is retrofit their house. Okay, so that way if an earthquake rumbles through, they typically should stand up or hold up when the ground shakes. Okay, so that's reduction of risk, reducing the risk of loss. Okay, quit drinking, drive within the speed limits. You reduce the risk of getting a ticket and things like that. Okay, quit smoking, ease up on your drinking, exercise regularly, eat proper foods. You reduce the risk of major medical problems and possible early death. Okay? Avoidance of risk. That means, sell your house here in California, right, and buy some property somewhere else where there's absolutely no fault lines, so you avoid any earthquake losses. Right? You can avoid risk by selling your car and don't own a vehicle. You'll never get into an auto accident in your vehicle if you don't have one. Right? That's extreme, but that's avoidance of risk. Right? But the practical way is transferring risk, paying a small known amount of money called premium, but a large uncertain amount of loss called a claim. And that's where transferring risk to the insurance company by buying the policy, and if a catastrophic loss exceeds our financial standpoint, right, the insurance company can cover that. And that's typically what you want to do with insurance, or why you want to have insurance. All right, so sharing is transferring kind of two ways. We have two types of sharing. We have reinsurance, co-insurance. So the first way is reinsurance. That means you're buying a policy from an insurance company, and it's a high face amount policy, and your insurance company is going to share it with other companies. So let's say you want a $3 million life insurance policy or a $3 million property policy, and the company you're buying from says, well, this is too much for us. What we're going to do is we'll assume $1 million, but then we'll negotiate with these other two companies to pick up $1 million each. And so your $3 million policy that you bought with this seeding company or primary company has shared the risk with two other companies. Right? This is called reinsurance. So if you did have a total loss, that first company doesn't take a major hit. It's shared, the risk or the loss is shared within three companies. So it reduces the impact in the industry. Right? This goes on every day. I mean, you might even have policies that are reinsured you didn't even know it. Okay? It's more of a behind-the-scenes insurance company function. But we're sharing the risk with multiple insurance companies. Co-insurance typically comes into play at the time of a loss. In the property and casualty world, the insurance companies want you to carry at least 80% of coverage to the value of property. Okay, because they're encouraging you to have adequate amounts of coverage, and if you don't, there's a co-insurance penalty where you actually have to pay more of a claim. So we'll talk about that in some later trainings. But in the health insurance field, we also have co-insurance, and that's where you're sharing in the cost of a claim with an insurance company. So you pay like a $250 deductible when you go in for medical care. After you pay your $250 deductible, then you pay 20% of your insurance claim. The insurance company covers 80% of your claim. And so that's cost sharing. You're sharing the risk with the insurance company. All right? So, and we'll get into some more of that as you go through the other training programs that I have, other webinars. Some other definitions, peril. Now, in the life and health field, you may get one question on what is a peril. And the answer is it's a cause of a loss. Fire, explosion, flood, cancer, AIDS, those are common perils. They cause loss. Now, that's probably the only one you're going to get on peril in the life and health exam. In the property and casualty exam, you're going to get a lot of questions on perils. So peril is defined as a cause of a loss. So then the next bullet here, a cause of loss form is a form that lists perils. All right, we have named peril forms like basic, broad, and earthquake because it names the perils that the policy covers. All right. So it lists what we're going to cover. So if you bought one of those policies and something happens and it's not on the list, it's not going to be covered. Now, in contrast to that, we have an all risk form, which is sometimes called the special form or open peril form. And this also lists perils, but it lists perils that the policy excludes. That means if a loss occurs and it's not on the exclusion list, it's covered. And so the named peril coverages and the all risk coverages are actually opposites of each other. Named peril form lists perils we cover. All risk forms list perils we don't cover. And so the all risk is probably going to be the broadest and more comprehensive because you can only list so many exclusions. And with an all risk form, if it's not on the exclusion list, it's covered. Okay. So a peril is a cause of a loss. Now a hazard is a condition that would increase the likelihood of a peril or a loss occurring. Okay. So a hazard would be like badly worn tires on your car. Now with badly worn tires on your car, you are more likely to experience an accident. So the accident would be the peril, that's the cause of loss, but the hazard, the badly worn tires, increase the likelihood of that accident occurring. So what I've just described, first of all, the badly worn tires would be an example of a physical hazard, something structural, something tangible. You know, like living next to an explosives factory. You can reach out and touch it. That's a physical hazard. There's other types of hazards like moral and morale, and you want to know the difference between these two. A moral hazard ends in an L. Moral ends in an L. L is for lie, lying, cheating, being dishonest. Right? Well, in the world of auto insurance, we get this every day. Right? We even tell people, hey, we're going to look it up, but I still got to ask you, have you had any tickets or accidents in the past 3 years? They'll still say no, and then we look it up, and they've got about 3 or 4 items. But, oh, there's page 2. No, people will lie to your face. We'll still write them because we verify it anyway. So, okay. But lying, cheating, being dishonest. Now, morale hazard ends with more A-L-E, more ale. So when you drink more beer, you get careless and clumsy. You got that liquid confidence. You probably take more risk than you normally would if you weren't drinking. I'm not saying morale means you're a drinker, but a morale hazard is someone with what's called an indifferent attitude, carelessness. Someone who drives fast, they go bungee jumping, they go skydiving, they're a risk taker. Okay? It's different than lying, cheating, being dishonest. But those people that drive fast are more likely to experience an accident or a loss. Okay? And that's what morale hazard. So moral ends with an L for lie. Morale ends with ale for, careless. Okay? That's one way to know the difference. Legal hazards, you hear stories of this. People that are suing for more money than they're legally entitled to. It's stop and go traffic. Someone gets rear-ended, and just a little bump, right? First thing they do is hang up their cell phone, clutch the back of their neck, open the door, and fall out on the ground. And I call 911. Right? I don't want to use up my minutes. Now they're trying to sue you for $3 million, claiming soft tissue damage. I mean, in the investigation, we know there's not even a scuff on the bumper to show that they got hit, and they're trying to sue for $3 million. You see, now the insurance company has to, number one, defend this. Number two, maybe offer a settlement, right? Or number three, they may have to pay that claim. Now, all of that costs money. Well, where do insurance companies get the money to cover that? Well, that comes from all of us paying higher premiums. So legal hazards, those people that are going for more money than they're legally entitled to, we're all paying for it with increased premiums. Right? So that's another. So those are the 4 types of hazards. Remember that a hazard is a condition that increases the likelihood of a peril or a loss occurring. You can view it as a catalyst to a peril. All right? Some more definitions. Loss. Loss is a reduction in the quantity, quality, or value of an asset. The loss doesn't have to be great. I mean, a dent in your fender shouldn't bankrupt you. And half the time, you probably don't even need to fix it. But it's going to cost you money to fix it. And that's what we're looking at. We want that financial attachment. Okay. If you don't fix it and you sell the car, you probably get less than what you thought you would get because they'll point out the dent. Okay. And so that's how you want to understand loss. There's 3 types of loss. There's property loss, there's liability loss, and there's human loss. And all of those cost you money. Right? So be aware of that. So you're going to get a test question. All of the following are examples of loss except, property, liability, human, and financial. Human doesn't look like it belongs, but actually does. Financial doesn't belong because in insurance, we attach everything to a dollar amount. Okay? So be aware of that. Now, as far as loss, there's two types. There's direct loss and indirect and consequential. Direct loss is direct physical loss, damage, and destruction of your property. All right, so say a restaurant burns down. That's a direct loss, damage to the restaurant. Now, because they're burnt down, they're closed. That means the business owner is not, they're not open, they're not cooking and selling to make money. All right, so the indirect or consequential losses during the shutdown because of that fire, the insurance company is going to pay the business owner lost business income that they would have normally earned if they were open for business. So that's indirect or consequential. So like the direct loss would be you get into an accident and your car's in the shop. So the indirect loss is now the insurance company covers the cost to give you a rental car so you can still go about your life while they're fixing your car. Okay? That's how you want to understand that. This is more in the property and casualty world, just to give you a heads up. Another thing, aggregate limit. Aggregate limit is defined as the maximum that your policy will pay for all claims during a policy period. So if you had a $3 million aggregate limit on your liability policy, that means we cover all the little claims up until we paid $3 million during that policy period. Once we pay $3 million during the policy period, your insurance is ended for that period. That means you've exhausted it. So that means now you're paying out of pocket because you used up your insurance. Sublimit. For the property and casualty test, if you have a homeowner's policy, let's just say you have $200,000 of personal property coverage, which covers your jewelry if it's destroyed by a fire on a national cash value basis. But if someone steals your jewelry, we're only going to pay $1,500. So that's what we call a sublimit. It's a limit on a certain type of loss within the overall policy amount that you have. Okay, so again, we had $200,000 for personal property coverage, but if someone steals your jewelry, the maximum pay for theft of jewelry is like $1,500. Right? So now for the life and health world, I should say the health insurance world, we have what's called an inside limit. So let's say you bought a major medical policy with a $6 million maximum lifetime benefit amount. That means they open up a checking account basically with $6 million in it for you to use towards your medical care. Okay. But there's a limit on certain types of care. So let's just say chiropractic care has a $10,000 limit. That's called an inside limit. So even though you have $6 million available for your health expenses, we're only going to give you $10,000 towards chiropractic visits. Right? So sublimit for the property and casualty world, inside limit for the disability or health insurance world. Kind of the same thing. It's a limit on a certain type of loss. Liberalization. Liberalization is where the insurance company is going to send you a letter, and we're going to raise the coverage on your policy for no additional charge. Right? So liberalizing your policy, liberalization. This happens more often than you can actually imagine, not really in the life insurance world, maybe in some of your health cases, but definitely in the property and casualty world, where the insurance company sends you a letter. It's an advance notice that we're going to raise the benefits of your policy for no additional charge. The reason you probably don't realize this exists because anytime you get a letter from the insurance company with a stamp on it that says this is not a bill, you probably throw it aside. But it could be one of these letters. Subrogation. Again, this is typically in the property and casualty world. Someone without insurance loses control and drives through your living room, damages your living room. Then you're going to sue them, right? And you're going to win because their car's parked in your living room. Right? But this person doesn't have insurance. Right? They got a part-time job at some fast food restaurant, not making a lot of money. And so when you win the court case based on their income, the judge orders them to pay you $50 a month until the debt's paid. Well, to rebuild your living room, $50 a month, that's going to be a couple months, couple of years to save up enough money to put a deposit on a contractor to rebuild your house. That would kind of suck. And so through subrogation, your homeowner's policy has a peril in it called vehicles. So if vehicle damages your house, you pay your deductible, the insurance company covers the cost to rebuild your house, and then the insurance company takes over the claim and goes after that uninsured motorist for the money that they advanced you. So subrogation, we pay you what you're legally entitled to as an insurance company, right? It's covered by the policy, and then we take over the claim and go after the responsible party to recover what we paid you. That's what subrogation is. The technical definition is transferring the claim rights to a third party. If you do get a one-word definition, look for substitution. Okay, so substitution, we pay and then we collect it on our own. So appraisal versus arbitration. Again, this is more in the property and casualty world. Let's say you have a dispute between you and the insurance company. If it's a property dispute, we usually resolve it through appraisal. The insurance company is saying we're paying this. You think, wait a minute, I should be getting more than that. And so you can agree to appraisal. Your insurance company picks an appraiser. You, the insured, pick an appraiser. These two appraisers then pick an umpire. They hear both sides, and then they make a decision, and that decision is final. Right? So for arbitration, that would be for liability disputes. Right? The insurance company says, we'll pay this for the bodily injury damages, right? And you say, no, it should be this. It should be a higher amount, whatever it may be. So in this case, again, you pick an arbitrator. The insurance company picks an arbitrator. These two arbitrators pick a third arbitrator that hears both sides and makes the final decision. Right? If it goes through an appraisal or arbitration, the decision is final. There's no appealing, right? Because you have to agree to this. Yeah. But it's typically a quicker, easier, cost-effective resolution of a dispute. That's how you want to understand that. In transacting insurance, there's 4 areas, right? First of all, solicitation. That's advertising, marketing, trying to get that client to meet with you. The next one would be negotiation. That's where you're meeting with a client, trying to sell the benefits and features of the policy, right? But you're negotiating with them, encouraging them to buy it. Execution of a contract of insurance and arising out of it means they bought the policy, right? You submit it, goes through underwriting, it's approved, it's issued, you deliver it. And then the 4th item, transaction of matters subsequent to execution of a contract and arising out of it. That means the policy's on the books and you're still making adjustments to it, maybe adding a rider, adding an endorsement, adding an insured, changing a car, whatever it may be, right? But you're dealing with the policy. You cannot do any one of these unless you have a license in your hand, right? Because transacting without a license is a misdemeanor. There's typically fines associated with it. Here in California, minimum $10,000. Okay, so basically, don't do it. Right? Now, you're going to get questions, and you got to kind of decide what part of transacting insurance it entails. So let's say you're dealing with a client, and they tell you to email them some additional information. Well, what part of the transacting phase are you in? Well, if they're asking you to send them more information, then you're in the negotiation stage. Remember, solicitation is trying to get them to talk to you. Negotiating means you're actually conversing with them. Okay, so just so you know. Parts of a contract. Now, this is where we get into contract law, and this is contracts in general. Consideration is defined as an exchange of value. Now, clients give 2 things of value. Number 1, they're going to provide personal information on the application, and number 2, they're going to pay premium. Money is valuable. The insurance company has to give something back, and they're going to give a promise. We promise to pay should you suffer loss according to the terms of our contract. So it's an act of filling out the application and paying the premium for the promise of receiving benefits. So make sure you understand. That's what consideration means, exchange of value, actual promise. Legal purpose. Well, the reason you bought insurance is to protect against a loss. But another way of saying protect against loss, it also means that you cannot get a gain. Okay? So remember, typically when you're online studying your required courses, they teach you one way of what the definition is, and the test will hit that topic from another side. So legal purpose means to protect against a loss, and that's what you're taught, to protect against loss, protect against loss. And then the test will say you cannot get a gain. Well, that's just another way of saying protecting against a loss, so be wary of that. And it may not be legal purpose. Your test goes a little crazy with the thesaurus. They might say legal objectives. All right, so they just, it's a thesaurus thing. So be wary of that. So get the concepts down. Agreement. In order to have a contract, we got to agree to it. So agreement can be broken down into offer and acceptance. Now, as an agent, you're representing an insurance company. Your job is to sell insurance to the public. So you're offering to insure them, and they accept your offer. You're right. I like your company. I like your policy. I think I'm going to go with you. So they then fill out the application and provide premium. When they present that back to you, right, that's a counteroffer. So you're offering to insure them. They accept your offer. Yes, we need the policy. Then they fill out the application, pay the premium. That's a counteroffer to you and your company. So your company accepts this counteroffer and says, well, yeah, we can insure you, but you have this pre-existing condition or you had this prior loss. So we can insure you. We just have to charge you a little higher premium. Do you still want it? So here's another counteroffer that can go back to the client. Okay? And they may or may not accept that counteroffer, but let's say they do. They say, you're right, I knew that was going to catch up to me, but I need it covered, so I'll go ahead and pay for it. So it really doesn't matter who makes the offer. Both parties have to agree to the conditions in the contract. All right? That's when we have agreement. You got to deal with competent parties. That's people in their right mind. Use your best judgment. Their companies are hiring you for a reason because they trust who you are and how you are when you're dealing with the public. So if you come across someone and they don't seem like they're all there, bow out gracefully. Okay? So beware of that. The competent parties means, well, they cannot be intoxicated or under the influence of alcohol or drugs because of their judgment impaired. Right? They're legally not capable of entering into a contract at that time. You cannot insure a minor. Right? Now, in most states, that's going to be anyone under 16 years of age. Because at 16, you can get a driver's license in most states. And in order to drive a car, you got to have insurance. So you can purchase insurance at 16, which is kind of funny because you cannot sell it till you're 18, right? Or majority age, sometimes you'll see. Right? So they got to be mentally competent, cannot be intoxicated or under the influence, cannot be a minor, cannot be deceased. And a very rare one is you cannot insure a public enemy. This is more for the life insurance exam. A public enemy is someone who's armed and dangerous and wanted by the law, and you're selling them a life insurance policy? So the police hunt them down, shoot and kill them, and their beneficiaries made money from the life insurance you sold them? No, that's not going to fly. Okay, and to be honest with you, you probably would know they're a public enemy, but when it goes to underwriting, they'll red flag it. Okay, so but those are parts of a contract that you need to be familiar with. So now we have parts of a policy. So in the property and casualty world, it's called the declaration page. In the life and health world, it's called the title page, or sometimes called the policy page. It just basically tells you who the insurance company is, who is the insured, kind of the effective date of the coverages, right, and the type of coverage. Now, as far as type of coverage, that's actually the insuring clause. So the insuring clause is usually part of that title page. It's usually a paragraph or at least a statement describing what type of policy it is. Right? So for life insurance on the policy page, there's a paragraph usually at the bottom of the page. It says you're purchasing a limited pay whole life policy to age 65, non-participating or whatever it may be. Okay, so the insuring clause just tells you this is the type or kind of policy you bought. Okay, it's usually part of that declaration page, title page, or policy page. The conditions clause spells out the duties and rights of both parties. It basically says this is what you need to do to collect from a loss. Right? And so another way of saying that is it spells out the obligations of each party. Right? Clients are obligated to fill out the application, pay the premium. If they suffer loss, they're obligated to notify the insurance company, then submit proof of loss. And the insurance company is obligated to investigate, settle, and pay the claim. That's the conditions clause. Right? Then you have exclusions. That's real simple. That's what the policy will not cover. Right? War, active war, aviation under certain risks, and life insurance, for property and casualty, like flood, earthquake, nuclear risk, common exclusions. Right? So those are the four parts of a policy. Now, in some cases, it's probably going to be two additional parts. There's usually a definitions page that helps define bodily injury or property damage. And then we have endorsements for the property and casualty world, and they're called riders for the life and health insurance world. Additional charge for additional features. That's like buying a brand new car, then they offer you the options package, like the undercarriage coating, the tinted windows, for an additional charge. But this is another way of personalizing the policy to cater specifically to your client's needs. And that's how that works out. Know the difference between a contract and a policy. So remember, parts of a policy, we have conditions. Conditions have to be met, right? But parts of a contract, we don't have conditions. I'm trying to give you a hint here. The exam will say all of the following are elements necessary for the formation of a valid contract, except conditions. Well, you think in order to have a contract, we got to meet conditions, right? Well, yeah, but we already met that in the agreement element. Didn't we already agree to conditions? You're agreeing to fill out the application, pay the premium. We're agreeing to cover you. Okay, so conditions is not its own element in the parts of a contract, but it is part of a policy. So be wary of this. Fiduciary. Whenever you hear of fiduciary, think of premiums held in trust. So when you're selling insurance, client's going to pay you money. Make sure it goes into this fiduciary or escrow account, right? And then the money is forwarded over to the insurance company. Now, this account must be separate. It's got to be typically a checking account within your state, right? Non-interest bearing, and it's only client money that goes into the account, right? So it's money that you're setting aside to pay for the client's policy. Actually, that they're paying you, you hold it, and then the insurance company will sweep the account if it's set up that way, right? So this money that you collect from the client, you can't commingle or embezzle. If you commingle or embezzle, you'll be found guilty of theft. So commingling is using client money for personal or business use, and then you pay it back later. You know, like you ran out to a client's house, you took a sale, they paid you with some cash, and on your drive home, you notice your gas gauge is on E, so you pull over, you didn't bring your wallet or your purse, and you have no money, no credit card, debit card, but you got these, couple 20s paper clipped to this application. So take some of these 220s, get some gas, get back to the office or get back to your house, replace the 220s when you get home, okay? Now, you just took client money for personal use, and you used it, even though you pay it back later, right? And that's illegal. That's a type of theft. So honestly, you probably won't get caught at that level, but if you do it at the lower levels, it'll escalate and go to the higher levels, and that's where you will get caught. So don't start it at the lower levels. Embezzling is just flat out taking client money for personal use with absolutely no intention of paying back. Now, like I said, if you're caught commingling or embezzling, you'll be found guilty of theft. You're going to want to pick fraud, but don't. Right? The only time you see fraud or when you want to pick fraud is when you see in the words willful or intentional. Then it's going to be a fraudulent situation. Right? But if you don't, commingling or embezzling is just a type of theft. Right? Refund. So let's say a client pays a premium, and that premium goes to the insurance company, and the client decides they want to cancel the policy out. So if the company's going to refund the money directly, they got to refund the money within 25 days. But you're the agent, and the company may actually give you, the agent, that client's premium refund. Once you, the agent of record, receive the client's premium refund from the company, you have 15 days to get it back to the client. So another thing you can do with client's premium refund, if you have it, is if the client is informed, you can tell them, hey, I've got your premium refund. What I can do, since they canceled this policy and gave you the money back, I can just take that premium refund and I can apply it for this other policy for you if you like. Okay. As long as the client is so informed, you can use the premium refund and have it applied to another policy for that same client only. Can't use it for something else. Okay. So be wary of that. This next line here, a producer may retain income commission in a trusted account to advance premium. This is a true statement, and this is something you typically will not be dealing with. But let's say, client pays you premium, let's say $100, and you get 20% commission. I'm just plucking numbers. And so you place this $100 into a fiduciary account. The insurance company takes 80%. They take $80 because that covers the policy. That $20 is the agent's commission that you're going to pay them typically at the end of the month, let's just say. Okay. And so if the customer pays premium on the first of the month, you send the money to the insurance company, but that agent's commission is sitting in a non-interest bearing checking account for 30 days till you pay them at the end of the month. It's kind of a waste of money. And so in some cases, and this is only for the exam, by the way, typically, someone calls you up, they want an auto policy, and they'll gladly pay you Tuesday for the auto insurance policy today. And so what you're going to do is you're going to use that agent's commission to advance the premiums for this client because you trust them that they're going to pay you by the end of the month to pay your agent their commission. That's how you want to understand that. And that is allowable. right? But they may change this up. A producer may not retain income commission in a trust account to advance premiums. Well, then it would be a false statement, because here I'm telling you it actually can be done. Not very common, but for the test, you might get that. Some additional terms: adhesion. When you hear adhesion, think of adhesive tape. We, the insurance company, we print the contract. So we put the verbiage or the wording in our contract. So if this contract is unclear and the client suffers a loss, we're not sure whether the coverage applies for them, they're going to win, right? It's our fault for not clarifying the coverage. So that's how you want to understand adhesion. If the contract's unclear, ambiguous, general, or vague, it will be determined in favor of the insured or the client. Okay, it's the insurance company's fault. Every once in a while, you'll see this listed as a take it or leave it contract on the exam. So there's kind of two ways of saying it. Okay? Aleatory. When you see aleatory or aleatoric, that means performance is based on an uncertain future event. Well, since insurance only insures uncertain events, right? You may have a loss, you may not, right? But there's a little more to that story. With aleatory, you may get more or less than what you paid for, right? So that's a tricky one. We have an individual, they go to an auto dealership and they buy a brand new car. Right? Now, they fill out the application and they pay premium because they got to have proof of auto insurance in order to drive that car off the lot. And so they do everything, right? They pay the premium, fill out the application. The agent gives them a binder, which is an unconditional receipt for payment. And so this person with the binder in possession hops in their brand new car, drives off the lot. They're looking back, waving at everybody, and drive into the building across the street and total their brand new car. Now, with a binder, they're covered. They get the value of a replacement vehicle. So they paid 1 month's premium, let's just say, of $100, and they received the value of a replacement vehicle because they just totaled that one. So they got more than what they paid for. Now, that may bother the agent, but that really doesn't bother the insurance company. Because even though this person paid one premium, got a full payout of a brand new replacement car, we have thousands of policyholders that will pay premiums for the rest of their lives, and some of them may never, ever file a claim. And so they received less than what they paid for. Okay, so again, for aleatory, you may get more or less than what you paid for. That's how you need to understand that. Bilateral. Most contracts are bilateral. Bilateral means promise for promise. Right? Your friends promise to help you move, and you promise to give them pizza and beer for helping out. It doesn't have to be in writing, right? And either one of you can back out anytime. Insurance is unilateral, meaning one-sided. Right? For life insurance especially, once we, the insurance company, issue the policy to the insured, they now control it by simply paying the premium. Right? After 2 years for life insurance, there's only one reason the insurance company can cancel you out: because you didn't pay the premium. After 2 years, a customer can cancel out any time they want, but after 2 years, again, that's the only reason for life insurance that the insurance company can cancel you out, because you didn't pay the premium. So that's one-sided. So again, unilateral. Uni meaning one, lateral meaning sided. Insurance is a personal contract. Personal contract simply means it's a two-party contract between the insured, the first party, and the insurer, the second party. Can't get much more personal than that. Anyone other than those two is a third party. Utmost good faith. When you're sitting with prospects, you're going to ask them questions, and you're trusting what they say is true and correct to their best of their knowledge. Okay? Likewise, you're going to present to them, and they're trusting what you say is true and correct. So utmost good faith basically means I trust you, you trust me. Because if we didn't trust each other, we wouldn't do business with each other. That's what that means. And I keep it simple like that, but when you take the test, they go crazy with the terminology. Your test defines utmost good faith as, we're going to rely on the representations of either party without any attempts to conceal or deceive. That's the exam way of saying, I trust you, you trust me. So yeah, you're learning a new language, and a lot of this stuff you're learning just to pass this test, and once you pass this test, this goes out the window, okay? Waiver. Waiver is a voluntary, intentional giving up of a known right. Right? So let's see, years ago, some of you might not remember, we had Desert Storm, and the older life insurance policies actually had military exclusions. So if you died in the military or active duty or in a war zone, we wouldn't pay. The insurance companies denied claims if you suffered loss in military action. Right? And so during Desert Storm, the insurance companies actually lifted the military restriction and paid to Americans that died during Desert Storm. And so they waived the right to deny claims because of military activity. How's that? So waiver means a giving up of a right. Now, once they give it up, then the legal doctrine of estoppel kicks in, which means once you give it up, you can't get it back. So once the insurance companies lifted that military restriction, later on they can't say, well, no, we're going to go back on, we're not going to cover military anymore. Okay, no. They set an example, they set precedents. So waiver is giving up a right, and estoppel says once you give it up, you don't get it back. Okay. Domicile of an insurance company. So we have three terms: domestic, foreign, and alien. I'm not sure which state you're in, but if you're whatever state you're in, if you have an insurance company that originated or organized in the same state that you're in, that's called a domestic insurer. If your insurance company originated or organized outside the jurisdiction of your state, they're called a foreign insurer. And if your insurance company originated outside the jurisdiction of the United States, they're called an alien insurer. Okay? So domestic means within the state, foreign is outside of the state, alien means outside the country. Right. Now, it doesn't matter where your insurance company is from. In order for them to openly, actively transact in your state, they have to apply to the Department of Insurance, fill out, pay fees, right, and get approved with a certificate of authority. Now, if they have a certificate of authority, they are admitted. Doesn't matter where they're from. Now, let's say, a company set up in your state, they don't want to get a certificate of authority or they couldn't comply. Right? So they're non-admitted because they don't have a certificate of authority. Typically, everyone who's watching this is getting a license to place business with an admitted insurer. In order to place business with a non-admitted insurer, you're going to have to get another license called an excess or surplus lines broker's license. Okay, that's the start. So, domestic, foreign, alien just means where did your company originate from? Admitted, not admitted means did they or did they not get approval to transact in your state? Right? They're not related. A domestic insurer is an insurer that originated in this state, whether or not admitted to do business in this state. A foreign insurer is an insurance company that originated outside your state, whether or not admitted to do business in your state. Right? So don't mix it up. The test will throw some curves at you. A foreign insurer is an insurer that originated outside the state and must be admitted to transact in the state. That's false. The must be admitted? No, they can be foreign and non-admitted. You see what I mean? So watch out for that. Okay. Types of insurance companies or insurers. The biggest ones you're going to deal with are stock and mutual insurance companies at the top here. A lot of times you might see commercial insurer, and when you see commercial insurer on your exam, they're talking about stock and mutual insurance companies. Now, as you can see, the first bullet under both of them, they have to be incorporated. Right? And all it is your insurance company got started, got off the ground, and they had to raise money to get started. So how did they raise money? Well, as a mutual insurer, they raise money by selling policies. And so if you buy a policy with a mutual company, you're going to get what's called a participating policy. Participating means if we, the company, make a profit, we're going to share it with you, in a sense you're the owner, we're going to share it with you in the form of a dividend. Now, the dividend is going to be tax-free. It's defined as a return of excess premium paid. So you're using after-tax money to pay for the policy. A dividend from a mutual company is just giving you your after-tax money back because in a sense, we overcharge you. That's kind of how you want to view it for the exam. Okay? There's a little more to that than that, but that's how you want to understand it. So you're paying $10 a month for a policy, and then the mutual company says, well, it only costs $8 to insure you this month. We're going to give you $2 back on the next quarter, and we're going to call it a dividend. Okay? So that's just a return of excess premium paid. Right? Dividends are never guaranteed, by the way. Now, in contrast to that, we have a stock insurance company, and they raise capital by selling stock. So if someone buys stock in a company, it's an investment. And so if the company makes a profit, they're going to share it with that shareholder, that stockholder, in the form of a dividend, but it's going to be taxable because it's investment return. That means if a policyholder bought a policy from a stock company, they're going to get issued a non-participating policy. That means they do not participate in the profits. Right? That money is given to the owners of the company, the stockholders. Right? So again, these are the two biggest competitors. Once in a while you'll hear of a mutual company converting to a stock insurance company, and this is a phrase called demutualization, when a mutual company transitions over to a stock insurance company. Right? It's a rare question, but if a stock company turns into a mutual company, that's just called mutualization. All right? Reciprocal insurer. Another way of saying reciprocal, look for inter-insurance exchange. I equate this to your homeowners association. So everyone who lives in this area, bought a house in this area, they have a homeowners association. So if you live there, you have to pay dues to the association. Now, in this association, you're going to vote for a board of directors to make decisions, right? And let's just say a windstorm blows through, knocks over a fence, and it affects a couple people's yards. And so the board of directors that you voted for, well, they have to determine how much is it going to cost to fix the fence, and where do we get the money for it? Well, since everyone pays dues to the association, everyone pays dues in their own account. You know, if we took a couple dollars out of everyone's account equally, we can use that money to fix that fence. So what you're doing is you're all insuring each other, right? And that's how you want to understand a reciprocal insurer, right? So it's kind of like a board of directors, right? A homeowner association, but it's just an insurance company. They're unincorporated. That's a key word, right? Remember, stock and mutual companies have to be incorporated. Reciprocals are unincorporated. And instead of voting for a board of directors, you'd vote for an attorney, in fact, to make decisions on behalf of the insurance company, right? So everyone pays premium. They pay premiums in their own account. So if someone suffers a loss, they dip into everyone's account equally to pull the funds to cover that loss. So we're all insuring each other. In fact, if you look at the phrase inter-insurance exchange, just read it backwards. We're exchanging insurance among ourselves. We're insuring each other, right? The bottom right-hand corner, fraternal. When you hear fraternal, think of nonprofit. Insurance companies that engage in charitable or benevolent activities. So Woodman's, Lutheran Brotherhood, Knights of Columbus, well-known fraternal insurers. They're nonprofit. If they make a profit, it must be dispersed back to the members, right? Because if a nonprofit company keeps profit, they have to transition to a for-profit company. Right? So, but look for charitable or benevolent activities. Right? Lloyd's of London. Now, they are an insurer, but they are not an insurance company. To be honest with you, Lloyd's of London is just a meeting place, for buyers and sellers of insurance to get together. Right? Kind of a rich kid's playground. Right? So if you're a wealthy individual, you're kind of bored, go to Lloyd's of London, join him, enter into one of the syndicates, right? And you're your own insurance company under the Lloyd's name. So if someone wants a $1 billion policy for something that no one else will touch, use Lloyd's actuaries and underwriters, and they'll tell you this is how much premium we would recommend that you charge to cover this risk. And so you say, hey, this is a premium I'm willing to take to insure you for this $2 billion loss. And they say, great, I'll take it. And so you take this premium, some of that premium you give to Lloyd's because you're using their facilities, their actuarials, their underwriters. The rest of that premium, you're going to invest. Because if this entity suffers that $2 billion loss right out the gate, you have to cover the $2 billion out of your back pocket. So you're like your own insurance company under the Lloyd's name. Lloyd's just provides the meeting place, right, for you two to get together, you and the clients that are looking for that coverage. So they're not an insurance company, right? Like I said, it's more of a facility for buyers and sellers of insurance to get together. Risk retention groups is in the property and casualty world. It's where we have some local businesses decide to form a group and to protect each other from liability losses. So they're just kind of sharing liability. All right. Captive insurer. Whenever you see captive insurer, think of we have a parent company that owns smaller companies that insure the parent company's risk. So that's how you want to understand it. We have a parent company, owns smaller companies, and those smaller companies insure the parent company's risk. keep it that simple. Right? Direct response mass marketing. These are direct writers. And what they are, we have an insurance company and they hire hourly and salaried employees. And they're going to basically market you. They'll send out flyers or emails directly to you, and then you respond to them. There's that direct response. We send something directly to you, and you respond to it. That's how we get business, right? But when you call up the 800 number or you reply with an email, it's an hourly salary employee that's going to manage that, okay? But that's how you want to understand that, okay? It's another way of offering insurance or selling insurance. By the way, since you're employees of an insurance company, they don't need a license, okay? Everyone who's going through this training, getting this license, you're being contracted by an insurance company typically. And being contracted, you need to hold yourself accountable by having your own license, right? If you are an employee or an officer of an insurance company, then you are under what's called vicarious liability. The employee is responsible for your actions. You're under the business license to transact and do what you do, okay? All right, with that, I just want to say thank you. Good luck in your studying and good luck on your tests.